Welcome to the Startup Espresso. I'm Hall T. Martin, the host of the show, where we talk about raising funding for your startup and the time it takes to have an espresso. I hope you enjoy this episode. Hello, this is Hall T. Martin with the Startup Funding Espresso, your daily shot of startup funding and investing. It's easy to get into a startup investment, but it can be hard to get out. An early exit deal structure gives the investor a way out. The TIN structure uses redemption rights. So what is a redemption right and how does it work? A redemption right gives the investor or startup a right to redeem an ownership stake in the company. So what are the terms? The TIN Capital Early Exit Term Sheet includes a 3x redemption right, giving the investor the sole discretion over their right to 3x their investment at the 3-year mark from the date of the investment. Investor sole discretion means each investor makes their own decision. Near the 3-year mark, the investor will have 30 days to decide if they're going to take the redemption or refuse it. If the investor takes the redemption, the payback will commence on the 3-year mark. If the investor refuses the right, then the convertible note will mature and the investment will convert to equity. In that case, the investor will then receive a return when the business reaches a liquidity event, which is primarily by an acquisition of the company. Investors who take the redemption right will work out a payback plan with the startup. Thank you for joining us for the Startup Funding Espresso, where we help startups and investors connect for funding. Let's go start up something today. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.